This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Claremont.
Welcome to Clear Money Talk. I am your host, Tim Claremont, CEO and founder of Clear Financial Partners. As always, I am here with Tyler, who is definitely looking better than me today. He wore his jacket, and if you're watching us on YouTube, you can see he's got a little pin going on and everything else. I'm much more casual today, unfortunately, so I'm feeling
That's all right,
feeling underdressed. You're probably gonna get more airtime now because you look better, therefore you should talk more. So
yeah, look better, perform better.
Yeah, we were just talking about how my hair is thinning as I get older. And I was just like, at the end of the day, I just think it's a function of intelligence. The smarter you are, the more the light beams off your head and burns your hair off, and that's just the way it goes.
That's a theory. Yeah.
We'll see. Anyway, look forward to being bald with me one day.
Yeah, I'm looking forward to it.
You're welcome. Anyway, we are actually re-recording today, so I'm gonna own our mistakes. So many times people make mistakes in this world, and it just bugs the crud out of me when they don't own them. That's who we are. Mistakes happen. We're human. Stuff happens. Yeah. Unfortunately, we recorded two shows that we recorded, and my microphone was on mute. So we have a horrible audio recording of these two shows if anybody ever really, really wants to see them. But consequently, we're going to re-record those two shows and share that information with you. So you're getting our second take at these particular ones. And we'll jump into the first one. I don't even know which one's going to be today. Yeah. If you may or may not even know what the second show is, because we'll probably record that separately, drop it separately, and you won't even necessarily know if it was a re-recording. But
correct.
We'll hit us with it.
We'll keep the old ones for blooper reels maybe
there
one day if we ever want to release a blooper reel.
We'll keep it in suspense.
Diving into our first topic, I'm excited. Round two, we're going to be even better this time at this one. Topic of the day: how can individuals diversify their investments? Let me start over with that. How can individuals diversify their investment portfolios to help mitigate risk?
Got it. How can individuals diversify their investment portfolios to help mitigate risk?
Correct.
So, and since we don't do any real editing on any of that, you're not going to get to start over on that.
No, you guys are going to get the raw take on that.
Let me start over. But actually, you're going to see that. We don't actually cut that out, so you'll actually hear it. So that'll be
Marshall, our editor, please leave that in there for the viewers.
That's fine. That's great. Okay, so how can individuals diversify their portfolios to mitigate risk?
Correct.
That's the topic for today.
Correct.
So we're going to answer that for you. There's a lot of different ways to diversify, and I think the most important thing to start with is what is diversification. And in fact, I was just having a conversation this morning with some of our advisors. I teach advisors around the world in our Clear Advisor program, various concepts related to running a successful financial planning practice, and we were talking very much about diversification versus concentration and the pros and cons associated with it. Generally speaking, diversification is the idea that you're going to invest in a variety of things so that if any one or two or three of those things don't go particularly well, you've got most of your portfolio going okay, so you're not going to, end up destitute or end up losing all your money or anything like that. In fact, every horror story that you ever hear about where people have lost all their money is typically an example of severe concentration and inadequate diversification. They've had all their money in one stock or all their money in one investment strategy or all their money in one thing. When you put all your money in one thing and you have over concentration in one thing, there's tremendous risk with that. Of course, with that risk can come the handful of really successful stories. A few people have put a lot of money into very few things, been very successful, made tons and tons of money, and that all gets us very excited as humans. We're like, oh, that'd be great. I want to do that too. But the majority of people who do that end up destitute. So our advice in general is diversify at least 90% of your portfolio. We never recommend investing more than 10% of your net worth in something so concentrated. That way you can at least take care of the basics. And for a lot of our clients that have higher net worth, we tell them, look, at least give us the first $5 million you don't want to lose. For clients who have less than $5 million, you really can't afford to lose a chunk of it. Maybe 10% of it you can risk, but most of it you need to be safe and prudent and take advantage of the basic low-hanging fruit that's available to you in the United States to diversify your investment portfolio and use the tax advantages that are out there. So as far as diversification, it's just divide your stuff amongst multiple things. But that means a lot of different things to a lot of different people.
It does.
So in our previous podcast, I believe we ended up breaking down This is the one that you don't get to hear because it's the blooper reel version. We broke down the concept of the bucket plan to share towards diversification.
Correct.
We talked about the concept of diversifying different investment strategies, so
Correct.
Both strategic and tactical. We talked about diversifying with asset allocation amongst a variety of different options like stocks, bonds, as well as categories, international, domestic, and so on. We'll touch on that.
Yep.
And I think we also talked about diversification amongst different product offerings, things that have guarantees, things that don't have guarantees, and things that have some of the other tax treatments there. Would you say that is that thorough?
Spot on.
All right, great.
I have my notes here, and that was everything I had listed.
Oh, look at that.
So,
That's all off the top of my head. You can
Good
watch
work.
if you're watching the YouTube video. This is off the top of my head from
Yep.
a few weeks ago. So
Excellent work.
we really kind of fly with it. So where do you want to start first, Tyler? Which one of those concepts do you think the audience wants to hear about first?
I think the most natural segue from what you were just talking about from a diversification standpoint might be asset allocation.
Okay.
Talking about that. That's, I think, when most people think of a diversification, they're thinking of, with my investments, how am I diversified amongst different things? When I say different things, I'm talking about different types of stock companies, different types of fixed income sources, different types of sectors within the economy, different parts of the world. And that's all part of that asset allocation, breaking out between those different things. So I think that's a natural segue, but maybe you had a different...
No, that sounds great. No,
All right,
I like
that.
it. Let's go there first.
Okay.
So, and that is probably consistent with the majority of people when they're thinking of diversification. That's what they're thinking of. They're thinking, okay, Tim, if I've got my 401k account, I'm investing in some stuff. Maybe I'm in the S&P 500 index, for example, and I'm thinking, oh, that's fine. Maybe it's 500 companies. Well, the S&P 500 is one way of diversifying. It's more diversified than, say, picking one or two stocks. It's not like you said, I'm going to throw everything into Tesla and Microsoft and see what happens, right? That would be a very aggressive, concentrated portfolio, not a diversified portfolio.
Correct.
So certainly not something we would advise. Not to say that you can't do that. You can if you want to, but it's a lot riskier than we would recommend. In general, what we're doing is we're saying, look, let's invest in a diversified portfolio. Well, the S&P 500 is just the biggest 500 companies in the United States, but it's a weighted index. It's actually overweighted based on the size of those companies. So, and you're missing a lot of other companies. You're missing small companies in the United States. You're missing international. You're missing emerging markets. You're missing investment strategies like value investing and growth investing. Those are not categorized into index portfolios. And while the S&P 500 has been a tremendous performer for the last 10 or 15 years, which we all get that, the fact is the risk associated with that kind of a portfolio is greater than that of a diversified portfolio from an empirical statistical capacity. So I'm not going to go into that because we could spend a whole podcast talking about the S&P 500.
We sure could.
But let's talk about asset allocation. One of the ways you try to create more diversification through asset allocation is by saying, how much of my portfolio do I want in stocks versus bonds versus cash? That's the first kind of breakdown in the decision tree as we think about it. Then you decide, okay, of the stock portion of my portfolio, how much of that do I want in alternative investments like real estate, gold, energy versus traditional investments? Then you decide, okay, of the alternative investments, how much do I want in each one of those three subcategories? Then you decide on the traditional side, how much of that do I want in the stocks in international versus domestic? Then in the decision tree, you go into the international and say, how much of that do I want in emerging markets versus traditional international like Europe, Australia, the Far East? Then on the traditional side, on the domestic side, you go into that and say, how much do I want in large, medium, and small companies? And then you might even further diversify to say, how much do I want in growth versus value versus index investing, which is different kinds of strategies. That's just the stock part. On the bond part, you're going to go in there and talk about how much do I want in government versus corporate bonds. And within the government, how much do I want in municipal, if applicable, which you may or may not want, especially in your 401k. Definitely give consideration to the tax treatment if you're considering municipal bonds.
Great point.
Versus government bonds, like long-term government bonds. How much do I want in short-term or long-term or medium-term? What duration do I want on those bonds? And then ultimately, of course, who's managing all of these portfolios? Because you've got to decide the right investors on that. I'm saying this all quickly just because diversification is a big concept. You can always go back and re-listen to everything I just said and write it down slowly if you want to and analyze this as much as you want to. And I'm not going to say these are all the categories, but if you cover all of these categories, I would say you're hitting the vast majority of things that most financial advisors are giving consideration to when they're designing your portfolio when it comes to asset allocation. And that's what people are thinking about. And Tyler and I will discuss on a monthly basis what is the mix of all those categories that we are recommending for our clients based on the current market environment And we'll also evaluate who are the managers that we like for each of those categories. Some managers are doing a great job in, for example, the small company area. And so those small company stocks, we'll use those managers for that purpose. And other managers might be doing a better job in large company stocks, for example, or perhaps there's good bond managers. It's rare that you're going to find a manager that's doing a great job in all those categories. I don't have any great stories of that. But the point here, statistically speaking, if you believe in buy and hold and modern portfolio theory and all the things out there associated with that, 93% of your success comes down to your asset allocation, meaning what percentages did you choose in all of those different categories. And less than 7% has come down to market timing. Whether the truth is there or not, whether you believe in modern portfolio theory or not, it really comes down to personal feelings about all of this. Everything about asset allocation and diversification all focuses on one little tiny piece of your entire financial planning life, which is rate of return. That little piece of rate of return is what is focused on. And that's what so many people spend all their time talking about is rate of return. How much rate of return did you get last year? How much rate of return are you getting this year? And the reality is that is just one little tiny part of your entire financial plan. There's so much more to financial planning than rate of return. And that a lot of people will have arguments and talk for hours on end about asset allocation and rate of return and everything else. And I get that that's important, but that's table stakes nowadays. There's so much more to planning than that. And you've got to give that consideration. When we look at our clients in their planning situation, we're always thinking about money in, money out. How much money are you putting in? How much money are you getting out after fees, after expenses, after taxes that you're actually getting to use when you want to? And that's not necessarily directly related to rate of return. Rate of return is a part of it, but there are a lot of other pieces to the puzzle. Anyway, that's a whole nother podcast too. So let's stop there with, generally speaking, asset allocation. That's your stock bond breakdown as far as that part goes. And making sure that you have exposure to all those things is a way to decrease your standard deviation, which is a measure of risk. Not to say that you'll necessarily get a better rate of return. That's not always the way it works.
Correct.
We're always trying to get the best rate of return we can given the risk level that our client wants to take.
That's right.
Yeah. Anyway, that was
nice.
That was a mouthful. Huh?
Asset allocation.
Yeah.
Check that box.
Done.
Good work. That's nice.
There's your 3-minute
I don't
rundown
think
on
there's
asset
anything else to
allocation.
add on that topic.
Yeah,
I mean, again, we can probably film an entire podcast on just asset allocation itself, but since we're talking about the broader scheme of diversification, want to make sure that we can hit on all these different categories that you talked about at the beginning of the podcast. Anything else you want to mention on asset allocation?
No, I think that's it. I'm done. Drop the mic.
Mic drop. He's gone.
Hey.
Where do you want to go next?
Why don't we go to bucket planning?
Bucket planning's good.
Yeah,
Yeah.
I think bucket planning is a nice transition. So
That is.
So bucket planning is the idea that some of the money that you're going to touch, you're going to touch at a different time. And because you're going to touch it at a different time, you should consider different risk tolerances associated with each bucket of money. You have your now money, your soon money, and your later money. Your now money, you're going to touch probably in the next couple of years. Any money you're going to touch in the next couple of years, you shouldn't be taking a lot of risk with it. Keep it safe. Keep it liquid. Make sure you're not going to lose any principal. Usually that money goes into cash, CDs, things of that sort. If you know you're going to spend it the next year or two, it doesn't make a lot of sense for you to risk loss. The soon money is the money you're going to touch in that 2 to 7 year time frame. If you're going to touch money in that window, you can take a little more risk. You want to get a little bit better rate of return, but you can't take a ton of risk because you know you're going to touch it soon. So there's various investment choices that might make sense for that. Finally, your later bucket is that 7 to 10 years plus money. When you're not planning on touching the money for 10 or more years, you can take more risk. And if you assign these buckets to pieces of your portfolio and you look at it that way, it affords you the opportunity to invest more of your portfolio with appropriate amounts of risk to improve your performance in the long run. Too many times we see people thinking that, hey, if I'm 65 years old, I'm going to retire soon, and therefore I might touch all my money soon. Therefore, I'm going to get really conservative. And then they think they're going to move all their money into this safe cash position. Well, the reality is you're probably going to live another 25 to 40 years. There's a big portion of your money that you need to save for later, for 10 years from now, when you're 75 or 80. That money you can afford to take a little more risk with because you have more time. And if you don't think about it that way, you may find that you're leaving a lot of opportunity cost on the table, a lot of rate of return left behind because you invest your whole portfolio as if you're going to spend all of it in the near term. And the reality is you should be breaking your portfolio into the now, soon, and later buckets. That's another way of diversifying your portfolio by diversifying the portions of your portfolio based on the time frame in which you intend to touch the money.
Yeah.
So another element of diversification.
That's great. And Tim, I'm happy you hit on a very crucial point, because our topic of today's podcast is how can individuals diversify their investment portfolios to help mitigate risk. Risk doesn't always have to fall into the category of loss of principal or rate of return. A risk of getting an inferior rate of return or whatever that might be. It can also be the risk of your portfolio not exceeding the rate of inflation. It can be the risk of your portfolio running out of money. So all these topics don't just hit on getting an inferior rate of return, but also running out of money, inflation, all these different concepts that come into retirement income planning, which we're specialists in. So all these different phases of the life, this diversification can be very crucial for. So I'm happy you hit on the bucket strategy, because, like you said, if someone went all in cash, especially at a point in their life when they still have a long time to go, that's a risk of potentially running out of money, or your money not growing enough to help offset the cost of inflation and other factors. So
yeah, you're spot on. Decreasing purchasing power is a big risk, as well as decreasing loss of principal. So loss of purchasing power is when you earn less than inflation, and it's excellent where you articulated. Frankly, we didn't talk about sequence of return risk, which is another risk that's out there that bucket planning can help us address. So there's so many different dangers when it comes to your money. Making sure that you're avoiding all of those potholes is it's what we do. I mean, if it was easy, then everybody wouldn't need us. And the fact is, it's not easy. And fortunately, there's people like us that are nerds at this. And I couldn't begin to tell you how to change the oil in my car. I have no clue. No clue. I'm not an expert at that. I have no idea how to do that. You might know how to do that. That's a beautiful, wonderful thing. I know how to work with retirement income planning. That's what I've learned how to do in my life, and that's what I enjoy learning how to do. There's a lot of other things out there that people are experts in. I mean, there are electrical engineers that we have. We have people build computers. I can't believe how AI can do what it can do. I don't know how any of that stuff works. I have no freaking clue. But we know how to do retirement income planning and build portfolios and deal with asset allocation, diversification, and bucket planning, all this other stuff. So why try to figure all this out yourself when you're focusing on becoming an expert in whatever it is that you do? It makes sense for us to, hire the people to change the oil in my car, because I don't know how to do it. It's not that I'm unwilling to do it. I just have no clue how, and I don't want to know how. I mean, it's a cool car. It's pretty, it's pretty fun, but I'm probably
pretty complicated.
I'm probably not supposed to change the oil in that car.
That's right.
But at the end of the day, my point is simply that you don't cut your own hair. You hire somebody that's an expert to do that, and that's what we do when it comes to this stuff. Let's go into some of the other categories. So we got bucket planning, we got diversification of asset allocation. We also talked about
investment vehicles.
So that would include things like 401ks, traditional IRAs, Roth IRAs, utilizing things like mutual funds, as well as alternative investment strategies, Delaware statutory trusts. Some of the other alternative investments that might be available out there. There are a lot of different ways of investing, and I would say that includes annuities. We have variable annuities, fixed indexed annuities. Not only I'm going to combine both investment vehicles and different kinds of accounts that have guarantees that don't have guarantees together, because they really all fit into those different capacities. When I started in this business in 1997 at 21 years old, they gave me this analogy. I haven't come up with a much better analogy than this. It's back to cars again, but that's how it goes.
Whatever works.
Yeah,
right?
they said, look, if you're trying to describe to a client the difference between an IRA account or a 401k or a non-qualified investment portfolio, pretend that they're different shells of a car. And each shell, of the car, it controls the tax consequences. So the tax consequences are different in an IRA. They're a little different than they are in a 401k. They're different in a Roth IRA. Each of those is a different shell of the car, and they determine what are the tax implications. But the engine of the car is how it's invested. And you can use as an engine, you can use mutual funds, you can use stocks, you can use bonds. You can even use an annuity as an engine or as a shell. That's kind of an interesting hybrid kind of account that you can use as both. But when you understand that, what you're doing is you're mixing and matching the right engine into the right shell of a car. And you want to have diversification. You want to have a variety of a fleet of cars that have different tax consequences. And you want to have the best engine in each car. And based on certain types of shells, other types of engines work better in those shells. Mm-hmm. And mixing and matching the right shell and the right engine in your vehicle is also what we do when it comes to retirement income planning. That includes your annuities, your LIRPs, life insurance retirement plans that we've talked about on other podcasts, your traditional mutual funds and diversified portfolios, ETFs, exchange traded funds. all of those are different kinds of investment vehicles that we then utilize with proper asset allocation and strategizing together with the right bucket plan for our clients' goals and risk tolerances to optimize that diversification. All of this being said, it's all about producing a steady rate of return, making sure our clients don't run out of money, minimize their taxes, and ultimately have as much safety in their portfolio as we can create with their given level of comfort.
Spot on.
Cool. Wow.
Like it.
That's pretty tight.
That is pretty tight.
Anything else we can talk about?
How much time are
We're
we
at
at?
20 minutes right now. That's
man.
not bad. That's
Yeah, we are tight.
You got a lot of meat right there, guys.
Yeah.
So I don't know that there's a lot more to say on diversification other than to give just the answer at this point.
The only thing I would add is life cycles. And there's 3 main life cycles. I said this in the last podcast. I think it's important to say because we're going to have listeners listening to our podcast, watching our video right now that are at different stages of their life. They might just be starting out with saving and planning for retirement. They might be somewhere in between. They might be right at the forefront, right at the 2-yard line for entering retirement. And entering these different phases, there's different life cycles that we talk about in our industry. There's 3 main ones. There's accumulation, there's preservation, and then there's distribution/gifting. And each of those life cycles require different attributes, different strategies, different approach to investing and planning than the other life cycles. And a biggest mistake that we often see when new clients come to us or when we're talking to people in the public, whatever it might be, is that people miss the crucial stage of preservation. They jump from accumulation straight to distribution and gifting, and there is a lot of different things that need to happen between those 2 cycles, and there's a lot of risk taken if people miss that crucial middle step. And diversification and help mitigating risk within your portfolio can come down to just the very broad idea of those 3 life cycles. So,
it's well said, Tyler. If I could reiterate, I would say accumulation. When you're in that accumulation phase Tyler was referring to, you're taking advantage of something called dollar cost averaging. You can look into that, and the benefits of dollar cost averaging can enhance your performance by investing in something that goes up and down a lot. Well, that exact asset, that exact catalyst that improves your performance in your accumulation phase becomes your worst enemy in your distribution phase. So if you keep that same strategy in accumulation into distribution, all of a sudden, all of those perks that you were getting in accumulation start to penalize you in distribution. And that's what sequence of return risk is. If you Google sequence of return risk, also known as reverse dollar cost averaging, you'll learn more about the consequences of that. And a lot of that happens from doing that exact mistake Tyler articulated, which is skipping that phase of preservation. At some point, as you get closer to retirement, you want to say, look, I built what I built. I can't afford to lose it. Let's start to be smart with it. That doesn't mean move everything to cash. We already talked about that's a fail. But it also doesn't mean stay aggressive with everything and pretend that you're not retiring in a few years. That's not a good idea either. So go into preservation, change your strategy, and then again, change your strategy again in distribution. And if you don't know how to do that, then work with professionals who know how to cut that hair.
Yeah. Sequence of returns risk is a real thing.
Oh, yeah. It's huge.
The old mentality of just throw all your money in a 60-40 portfolio and draw out 3 to 4% and your money will last your entire retirement experience.
Yep.
It can work, but it's not advisable. I guess
I struggle to come up with a better word for this right now than asinine, but ultimately that's the way I feel. It's just truly not the best strategy anymore. Yeah. There's so many better ways to do this.
A great statistic with the reverse dollar cost averaging I heard is imagine you have a $100,000 portfolio and the stock market goes down 50%. So all of a sudden your $100,000 portfolio is at $50,000. What rate of return do you need to get back up to $100,000? A lot of people would say 50%, right? Portfolio went down 50%, need 50%. Wrong. You need 100% rate of return at that point to get back to where you started.
Oh, it's so true. Simple math, but it's like, oh my gosh, that's horrible. That's right.
Yeah.
Yeah. If you're dropped 50%, 100 grand goes to 50K. What do you need the 50K to get back to 100 grand? 100% rate of return.
And that is sequence of returns risk at its core.
There's a lot of problems that could come into that. Yeah. Well, that's the tip of the iceberg on a whole nother topic that we're talking about.
That is. Maybe we can. That's another podcast topic. So tune in for another time.
As we mumble, and you can't understand what we just said, that's fine. We're going to move on. Let's go with just the answer.
Just the answer.
Just the answer, making it tight. So diversification. So quick, just the answer. Diversification is the concept of spreading your wealth over a variety of different strategies and investment choices to try to decrease your risk. That's the idea. Diversification does not guarantee against loss. There's no way to guarantee against loss if you're taking risk in a portfolio. That's the way it works. We're considering various things like asset allocation. That's diversification amongst stocks, bonds, cash, as well as diversifying amongst the categories of stocks, the categories of bonds. And when you're thinking about that, that includes your international, your domestic, your alternative investments, your large, medium, and small companies. We also didn't talk about strategic versus tactical investing, another means of diversification, and growth and value investing versus index investing, all of that. Then we touched on bucket planning for diversification and said, look, you also want to diversify the portions of your portfolio you're going to touch in the now bucket, the soon bucket, and the later bucket, and take different risks with each of those. Then we also talked about diversification into a variety of investment products. That includes things like LIRPs, life insurance retirement plans, annuities, mutual funds, exchange-traded funds or ETFs, stocks and bonds individually as it might be considered, as well as alternative investments and all kinds of opportunities that might exist there, Delaware statutory trusts, some other real estate offerings. All of these kinds of things are examples of diversifying your investment strategies and your types of shells of cars, as we used the analogy earlier in the longer show for those that are listening to Just the Answer. Things like 401ks, IRAs, Roth IRAs, non-qualified accounts, all of those factor in to creating diversification in your portfolio, and they work together in a wonderful harmony to create your retirement income in a way that hopefully makes it so that it's as high as possible, as tax efficient as possible, never runs out of money, and leaves behind everything that you want to leave behind to your heirs. That's what we work on.
Very nice. So, just the answer.
Just the answer. There you
and
go.
If you're overwhelmed right now, we understand. It's like drinking from the fire hose when we're listening to Tim, but that's a good thing. And if you are overwhelmed and you just want to pass the puck to somebody to help you with this stuff, consider giving us a call. What's our number, Tim?
503-579-1000.
1000.
503-579-1000. Give us a call. Schedule a get acquainted call with us for 15 minutes. We'll just have a quick conversation with you. See if it's a good fit. No harm, no foul, no cost, no obligation. Just love the opportunity to chat with you and see if there's something we can do to help you out. That's what we live for.
That's why we show up every day.
That's why we show up every day. So what do you got for us for trivia?
Yeah, I got something for trivia. I'm not going to reuse the same ones from the last podcast.
I know, that's not
the
fair,
listeners are like, he's just going to reuse the same one. Tim already knows the answer.
All right.
I don't know
the trivia.
And I got one that I think you'll like here, Tim. Okay. So
hit me with it. What you got?
What was the first movie in the Austin Powers franchise?
Well, I mean, the Austin Powers franchise, I'm thinking of Austin Powers, that would be, I think it was like Austin Powers, that just his name, Man of Mystery, maybe they called it. Then there was later there was The Spy Who Shagged Me, and then there was Goldmember. I think it's just Austin Powers, unless you're going to reference like some of the prequels to that, which would have could have included some of the other ones that were not so Austin Powers, but might have been referenced. I'm thinking of, So I Married an Axe Murderer and all that kind of stuff. That was more Mike Myers pre-Austin Powers.
Tim is clearly an Austin Powers fanatic.
I'm going to go with Austin Powers' Man of Mystery.
I'm going to give this one to you.
All right,
you missed a word, but it's Austin Powers.
Man of International Mystery?
Oh, man.
What was it?
International Man of Mystery.
Man of Mystery. There it is. Yeah,
very
baby.
well.
Yeah.
That's why I wanted to do that trivia question, because I knew he would drop that. And
oh my goodness,
that's a good one to end on right there.
I fell over again. All right, yes, no, that's a good movie. I watched way too many times when I was younger.
Yeah.
Well, thanks for the layup trivia.
You're welcome.
That was fun.
That'd be a nice one. I've been stumping the nerd a lot lately.
Yeah, you have been. Well, I'll take the layup. Yep. Hope you enjoyed our show today. We kept it tight, under 30 minutes. Plenty of information for you to learn in terms of diversification. Yep. And if it went too fast, just slow it down. That's the benefit. You can always slow us down.
Listen to it again.
Whatever you want to get.
Check out our other podcasts for more learning, and we look forward to seeing you guys on the next one.
Thanks for your time. Join us on Clear Money Talk.
Investment advisory services are offered through Clear FP Advisors, LLC, or Registered Investment Advisor. Securities are offered through Clear FP Securities, LLC, member of FINRA IPC. Exposure to ideas and financial vehicles discussed should not be considered investment advice or a recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments may fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Timothy Claremont is licensed in your state, please contact his office. Clear FP Advisors, Clear FP Securities, and Clear FP Life LLC are not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide tax and/or legal advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through ClearFP, LLC NPN number 194283777 and or ClearFP Securities NPN number 197499604. Any discussion of general investing strategies or specific securities are for conversational purposes only and should not be taken as a guaranteed endorsement or recommendation.